UK rents fall for the first time in 5 years. What's going on with the UK residential market? Is it another nail in the buy-to-let coffin? After years of relentless increases, the UK rental market has finally done something we haven't seen since 2020. Basically, it's gone into reverse. But before tenants out there celebrate, and before you all run out to start selling your buy-to-lets, as you were often told to do, let's look at the underlying fundamentals. Okay, what's driving the drop? 5 interest rate cuts over the last 12 months have lowered mortgage costs to landlords. Some landlords are passing this on to tenants, so it's making rents not go up as much or even fall in some cases. And lower mortgage rates are allowing more tenants to buy. So that's a good situation. Sitting tenants are still paying more. Annual renewals are up by 4.5% per annum. And if you're an existing landlord, that's good news. The regional differences are huge. As ever, London has seen a fall of 3%. Wales, the North East and Humber follow it. In the East Midlands, the West Midlands and the South West, we've seen increases. Now, why is that? In the Midlands, because we've still got the HS2 infrastructure levelling up agenda going on, and rents were fairly cheap up there, so they're going up, which is pretty strong. In the Southwest, post-COVID, you saw a lot of people leaving the location and moving back to London. That work from home was just too far for them to go, so they moved away from there. That's what's been really skewing the market and why we're seeing rents go up in some locations but not others. Rents are still higher than the 5-year average. Average monthly rent is £1,373, if I read correctly, which is £350 or 34% higher than it was 5 years ago. So that's quite a big increase. So bear in mind, if you'd have bought 5 years ago and you'd had a mortgage that was pretty tough, you'd have £350 more per month to pay it now. And that's the whole point about buying with a mortgage, is that rents will go up. Inflation over the last 5 years, I would say it's probably something in the region of 30%. So that means your mortgages have actually shrunk. So it's not a bad idea to have mortgages on properties and rent them out on a regular basis. So the overall market balance is improving. Supply of rental homes increased 15% in the last year, which is good. Tenant demand fell by 10%, again, which is great. And we're now getting 11 new inquiries per property, down from 16. That's 11 compared to 16. That's still huge. You're still looking at a vacancy take-up rate of something like 25 days. Okay, because it is a slower market, rental listing prices are falling a bit. I think across the board, we've seen about a 20% fall in rents. People are reducing their rents on an ongoing basis. And people say to me, what can go wrong when you're buying a buy-to-let? That's one of the things. You have to reduce your rent. So, just be aware of that. Investor activity is picking up. Buy-to-let lending is up by 17% this year. New rental home purchases are up by 28%. More supply could keep rental growth in check going forward, which is great. We don't want to kill the golden goose, so to speak. Non-UK landlords are on the rise. 20% of buy-to-let companies set up this year were set up by overseas owners, up by 13%. 10 years ago. How about that? So one of the things I do a lot is talk to people about using, if they don't get a tax break in the UK, i.e. they're not EU nationals and they're not UK, then why not use a company to buy? The biggest investment groups we're seeing are India, Nigeria, Poland, Ireland and Italians. EU share has dropped from 65% to 49% in 2025. So the outlook for this year, rental market continues to cool. Student housing oversupply could push more larger homes into the general market. Renters' rights bill will shift landlord strategies and landlord exit rates, remain steady. Takeaway for tenants, more choice, slower rent rises and so on. For landlords, it's still a good buying opportunity. What sort of properties? Personally, I would say we're seeing a lot of studios being sold. It's about 15% plus yield on those. And 1 beds, we're looking at 8% yield on many of those. The reason being is that if you think about it, if you can do your work from home, and there's no way you're going to get people in the office 5 days a week. For this generation who are working now, it's become endemic. They won't be able to work from the office for 5 days a week. So they will work from home, and if some sort of compromise will be met. And what does that mean? It means that people want to stay in a cheaper apartment in town, perhaps buy one to live in during the week, and then they can Airbnb it at the weekend. Or they stay in a HMO, a house of multiple occupancy for professionals, and that's a good thing. So those are good angles to take when looking at what properties you should be buying. HMOs perhaps, professionals, studios, 1 beds, that sort of thing. 2 beds are always, worth their weight in gold. They'll always go up longer term. And houses, longer term, will always outperform apartments, just in the short term, and they're more difficult to rent. You know, you've got a lot of poor yield. You know, if you've got dogs, they don't pay rent. Kids don't pay rent. You've got a garden, that doesn't pay rent. So houses have got a lot of wasted space. But it's a different market. It depends what you're into. So that's really basically what we're looking at this week, is what's going on in the rental market and what you should be aware of. It's good that it's calming down, okay, and it's still a good buying opportunity. Just a question for this week. Paul B. 1970 said, how can you cut interest rates when inflation is rising? Seems crazy. Well, what it is, Paul, is that you've got to balance out the need for the economy to grow. And if interest rates are 4% or 5%, then people are going to keep their money in the bank. You know, companies are going to do that on their balance sheets. However, if interest rates are 2%, companies will invest that money. People will take the money out of the bank and then invest that. It'll push the economy up. That's what it's all about. It's a case of balancing it out, and that's a very difficult thing to do. And you know, the Bank of England, hats off to them. It must be very hard to manage that. And that's why at the last meeting they had such a conflict about what they should do with rates. So there we go. That is Market Wrap 270 for this week. Thank you very much. Do take care. Cheerio.